we've been saying for some time that it means that growth and or inflation are going to disappoint on the low side of expectations within the next year. I think that the Fed is not paying too much attention to this to this indicator, because it's looking at backward-looking indicators, so employment and the headline measures of inflation, not the leading indicators. So the leading indicators of inflation are pointing down to deflation, actually. Increase in spending is $2 trillion over 10 years. I know that the Republicans want a cut in spending over 10 years. So right there's a big gulf. There are three areas, though, that the Biden administration is willing to cut spending. The first is the Small Business Administration. Well, small businesses are the biggest job generators. And I think I read somewhere in mulling over this budget that one of the reasons to this is they want to stop employment or slow it down so that the Fed will slow down. That's kind of interesting. The other interesting spending cut is Department of Transportation. I think I've read about 5 train derailments in the last few weeks, and planes at airports at risk of running into each other, lots of reports of those. So I'm not sure that's the best place to cut, but nonetheless, there are a few cuts in the budget. It'll be interesting to see how the negotiations go. These budget proposals are typically a no-go. They're going to change radically, but I did want to give you a sense of the massive tax increases across the board that the Biden administration is proposing to close the budget deficit. For example, the corporate tax going back from 21% to 28%, a tax on share buybacks of corporations going from, well, they're saying 1% to 4%. So a fourfold increase there. Yeah, 40% increase, roughly 40% increase in the corporate tax rate. But even taxes like the Medicare tax for individuals making more than $400,000 a year, they're proposing that go from 3.8% to 5%. Now, that sounds like kind of a small increase, but that's a 30% increase. And we have other examples of a doubling, the tax on foreign earnings going from 10.5% to 21%. That's a doubling. So we have the tax on carried interest, once again showing up. That's nearly a doubling from 20 to 39.6. So a lot of tax increases, including ones that we think would hurt capital formation. Capital gains tax going from 20 to 39.6%, the dividend tax 21 to 39.6%, a net wealth tax being initiated at 25% for individuals making more than $1 million. But we're beginning to see brewing here a banking crisis. And the question we have to answer is this going to become systemic like Lehman Brothers in 08 or 09? Or, and we're betting on this latter one here, is this more like 1994 when Orange County went broke and that created a crisis to which the Fed responded? We think it's much more like 1994 because the setup was similar. In 93, 94, commodity prices had taken off as we were coming out of that recession. It was an S&L induced recession, so housing. And the Fed was railing against those price increases with higher interest rates. It was a terrible year for growth stocks. And that's how we would characterize 2022. But when Orange County went bust, that was a sign that the Fed had gone too far. And the Fed did change its spots. We believe that the failure of Silvergate Bank and Silicon Valley Bank, which just went, the FDIC put it into receivership today. Both of those are telling us a couple of things. One, that, the Fed has gone pretty far and is causing a lot of banks, not just these, difficulties. And I'll describe how in a moment. So we do agree with those who say, well, Silvergate had a concentration of crypto customers, and Silicon Valley Bank had a high concentration of venture and venture-related customers. And so that's all true. But if you look at what has happened here, it is the deposit outflows that have triggered the problem, the crisis. We know that venture capital is facing a bit of a liquidity squeeze. Fewer deals are being done. There is more risk aversion in the marketplace. And so these companies are having to draw down their deposits. Most bank with Silicon Valley Bank. They're drawing down their deposits because they have to. I think what we're seeing today is in some of these banks under collateralization. But in both cases, what do we have going on? These are centralized entities, and they're not transparent. Certainly when it came to FTX, not at all transparent. Centralized, opaque, completely opaque. The banks have to do more disclosure, so they're not as opaque. You could see that they were upside down in terms of interest rates, having to pay up for deposits, but earning a very low yield to which they committed at a bad time when interest rates were very low, thinking they were being smart. And so this is nothing to do with crypto. In fact, Silicon Valley Bank, I don't think you're going to see a mention of crypto at all there. So it has nothing to do with crypto, but it does have something to do with what happens during banking crisis. Usually these banks are upside down. They start losing deposits. In the case of Silvergate and Silicon Valley Bank, there's a run on the bank. When you get Peter Thiel and other famous investors and well-respected investors saying, get your money out of there, they're going to take the money and run. And so this is nothing to do with crypto. This has everything to do with Fed policy, we believe, taking interest rates up so dramatically, the most rapid rate in history, and taking money growth down from 27% 2 years ago to -3. So that's a 30 percentage point swing. That has never happened. We've gone back to the Great Depression to see if that was the case back then as well. It wasn't.